All right, hey you guys, I figured I'd film one more video since I'm already doing this, got the camera out, got the microphone out, and so I want to talk to you guys about expansion and compression, and these key concepts that, I mean, I went over this with, was it? No, it was Colton. Colton was the first person. He showed up to that live stream, the only one that showed up to that first live stream, and I feel like that was probably the best piece of advice that I've given anybody in a while. Because it even unlocked a little bit of things for me. And so I want to go over this in a video format to really get your mind thinking about how am I balancing KPLs and Marty? How do I balance back and forth between the two? And this concept keeps coming up every single day that I do my study. So I'm going to walk you through how I use kind of this idea of expansion and compression within the given instrument in order to make an informed decision on a daily basis. And so what I'm talking about here is you're gonna have a ton of instruments. You know, we have ES, NQ, YM, RTY, 6E, CL. We'll start looking through some of these, but we generally talk about what? The indices, the index futures. So we talk about ES and NQ a lot. We don't really talk about YM as much, or RTY, but each of these they all have similar characteristics. And one of the things that I've noticed as I've been going through all of these different instruments is they have these periods of a consolidation phase, right? So if we were doing some sort of consolidation, or if I was to mark this out here, like let's just mark, let's do this. Let's just do a highlight region. If we had looked at this day, let's just consider this was a strong day down. I'd go, okay, the next day is likely to be a range day, right? Or an expansion, or sorry, a range day, not an expansion day, meaning that I would expect there to be a range somewhere within this range. And did we do that the following day? Yes. What did we do the following day? We filled in the volume profile. What I'm doing anytime I'm looking at a chart, I'm imagining that there is a volume profile being filled out based on the orders that are being taken, or the orders that are being transacted on the market. And so in this particular scenario, we had a trend day, or a price exploration. Price was exploring how low could it go. There were people that were continuing to be willing to sell on this particular day, on multiple days, right? Multiple days, on this day, on this day, on this day. We had a multi-day trend to the downside. And then we started to see some resilience. We started to see some bouncing. We still did get a sell-off here. But what does that tell us? That usually tells us that after those moves, we're likely to see more of a contractionary phase, a balancing, if you will, of the order book. And so this balancing has to occur, and that is usually where we're going to start seeing days that are going to consolidate. So what I do is I've created the expansion compression model. I'm working on that for ES. I'm working on a way to make it even better. But at its core, what is the purpose of that particular model? Well, the purpose of that model is to know we have a couple different types of really good scripts. We have Marty Martingale that is really, really good at a grindier, choppier, uptrending market. When things just kind of suck and we hate trading them, Marty does really well. On the flip side, KPLs are much more of a range instrument with higher volatility. They only work exceptionally well, and you have a major advantage and a major edge when you have at least a certain average true range throughout the session. So you need more volatility. You want a little bit of a bias towards the downside. You want to be able to have the potential for some gnarly movement to occur. But with that, the other piece of tech or tools that we have with KPL1U is that we can set it up to trade these levels like the OP or the CP or the median level. And when are those good to be traded? Well, we can trade it on we can trade it on trending days when there's not a ton of volatility. So generally, on days that Marty works out, as long as we've consolidated for a couple days, that level, the OP or the CP, will work out. The other times that the OP or CP will work out is if there is high volatility to the downside as well, after we've seen some consolidation. So as we can scroll back here and go, okay, here's a good example. This day, did we have some compression or anything? No, we had a trend up, and then we had this weird trend down. But okay, so we've trended. Okay, now we're trending still. We're starting to do these trending things where volatility is getting out of control. Increased volatility, that opens it up for the CP and OP levels to work, and it did. Well, then we finally start to get some price validation or price bouncing in this particular area here on August 5th. And then what happened? We consolidated. We got a decent consolidation within here. Again, though, does that mean that I would have traded CP or OP on this particular session? No. And this is part of my rules that I have for using KPL1U on CPOPs. I want to see at least 2 to 3 consecutive sessions where price is starting to coil. And I say at least 2, if not 3, because this is August 6th. But if we go back to where what price has done recently, I would go, that's unfortunately unfair. That's kind of unfair. But if I were to say, sheesh, it's too many opportunities to make money. But like, here you go. I mean, this is a decent trend down, right? Even though this was a wicked bounce up and then a move down. And even though you would have went short here, I guess this is a fair one. I would say you definitely wouldn't have wanted to trade this one because you would have potentially went long, got stopped out short and went long, and then stopped out long and went short. So you would have gotten kind of chopped up on this. But that's a great example, right? Why do you want to wait at least 2 consecutive consolidation days? Well, because we needed 1 day, 2 days, 3 days, you would have finally got it. But if you would have did it on this day, you would have been more likely to get chopped up. This, even on a 3rd day, is still likely to get chopped up as we did, but it still worked out. And the reason it worked out was simply because there was enough volatility to the downside to offset those losses, or at least eat up most of the losses that would have occurred at the Globex and earlier trading hours. This, for example, though, is a great 1, 2, 3, I'd say this would be the 4th trading day, August 23rd, where we've had some consolidation. We got that breakout validation. Again, this moved out. Even if you didn't catch the entry right here, if you have a buffer zone that's 12 points, what is this? 12 points would make it 6 to the upside, 6 to the down. 5597.75 plus 6 ends up being 5603.75. So you would have barely got in on a long off of the OP level right here, and you would have been able to make a solid return. Again, using this expansion to compression idea. And again, it works. You want to have a couple of different rules in place, or at least I do. Depending on the instrument, sometimes you're going to want to wait at least 2 days. Sometimes, and this is where you need like a decision tree almost. Like if it does this, do this or this. If it does this, do this or that, and kind of create a decision tree. But that's how I would formulate this. And this is kind of how my models formulate it and create that expansion compression model. But what you want to do is you want to have a few of these rules. They can be very simple at first, kind of outlined, so that you know going into the following day, am I willing to take these longs? Should I run Marty? Should I be looking for KPL1U? What should I be doing? Should I be trading the KPL? Should I be trading the CPOP levels? What you really want to be able to do is to determine between those types of things what you're looking to do. And so we get into this range again, really range bound. I mean, we are really, really range bound. We spent 1 day getting a drop, then we consolidated. If we were to trade this after, let's just say this was a consolidation day, you're like, okay, we should get a trend movement, and we didn't. That's okay. That's okay to take losses. Like if you were to have traded this OP level on a day like this, we thought should be a breakout. Now, why would you not trade this OP level or the CP level on a day like August 27th? There's no news. There's no catalyst. There was nothing. Everything was waiting for the NVIDIA earnings that occurred today after hours. So there again, you need to have some specific rules and layers in place to really help you. As you stack some of these things, then you go, okay, this wasn't a really good range day to be trading on the 27th. But then if we get here to the 28th, if you understood, again, based on how markets react to the news, you go, okay, well, it's worth it to try and trade that CPOP level potentially today. We've consolidated now how many days? 1, 2, 3. We're going on day number 4. Day number 4, I'll take that trade. And so my expansion compression model, if I were to show you a little bit more of my model, in fact, I'm more than happy to show you guys it. This model has a ton of different features and variables and things like that built into it. My most simplistic model that I got here is probably one of the more simple ones. There we go. Okay, so very simple and easy, right? Contraction, 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 contraction. These are all just contractions. You're not getting a lot of expansions, but you were getting expansions back in the day. What is all this essentially based off of? Well, it's essentially pulling all of the knowledge and all of the information that we are getting. In fact, I should rerun this model right now while the markets are running like this. This is all essentially built on the fundamental assumption that you're taking into account the news, what type of news is occurring, and then what are some of those macro market trends that are occurring, and then just how have we filled in the volume profile at a particular level day after day. And you know, we're looking at this on a 15-minute chart. The other thing you can do, and the thing I do, is I will go to a larger time frame like the 65-minute chart. And if we were to, again, look at this range, let's see here, okay, so if we were to kind of draw a range that this market has seen, that's the range. How many days have we been within this range? Well, 1, 2, back down, okay, recaptured, 4, 5, 6. So, and this is more macro, 7th day, but after 6 to 7 days, 6 days of being in this channel, if you're looking at this from a macro perspective, we've consolidated more than enough. Everyone who needed to get their orders filled within this range got their orders filled. And now we have this ability to start testing lower lows. And that's what you're likely going to start to see going into tomorrow's session. More lows being tested. Why? The volume profile was filled out within this range. If we go back to another freaking range over here, you know, we could mark this range out. You know, you could mark out another range right in here, right? You could go 1, 2, I mean, it's kind of a trendy day, but still it was within this range, right? 1, 2, 3, 4, we still were filling in the range. That's day 4. Then day 5, we finally got a runner up. And then day 6 was just another just bloodbath of a drop. And that's, again, beginning of August, right, as we had that major range down. So what you need to realize, and again, just to recap and everything with you, you need to realize where your larger picture support and resistance is, and how many days you've spent kind of consolidating within a channel. And the longer that goes on, the longer that coiling occurs, the bigger the break, or finally, eventually it's going to break. And here's the thing, we don't always know whether it's going to go up or whether it's going to go down, but you don't need to know that with the KPL bot. You don't. You can go long above, short below, doesn't matter. And if you are using that CPOP level, this is the incredible part, is that you're going to get a breakout strong to one side or the other, right? So here, great breakout down to the downside. Scroll down over here. This move right here, getting long in this area, great move to the upside. You want to use, I really want to be specific about this last little part before I end this video. You want to use on days that are likely to trend, doesn't matter whether you know which direction they're supposed to trend, days that are likely to break out and trend in a direction, you want to use the CPOP levels, and you want to use Marty. Marty is generally going to be good for those, but you don't want to be using the one day you don't want to be using Marty for those trend days is when there's any sort of potential downside volatility trends. So I'll trade Marty if there's some downside volatility after we've consolidated. You know, in this period, if we go back to ES and look at this, you know, I would trade after a large drop like this, and you're getting some consolidation, I would trade Marty for sure, you know, on a day like this, or even, you know, a day like the following days, a couple days, right? Knowing that a general fill in of the volume profile is going to occur for at least 2 to 3 days. Contraction is always going to be more common than it is to see expansion or a price discovery type move. Price does not look to discover or break out very often. It's generally going to look to consolidate. So if I've gotten, you know, this really strong consolidation for some time, this is where I'm going to start backing off. You know, I've been in this range now 1 day, 2 days, 3 days. If I got out on Marty and got my longs off and I was lucky, I'm like, oh, thank goodness. We get back up in here. And again, more heavy volume transacting. This was a news day. I'm starting to get less excited about using Marty. And then especially right now, I mean, we've been in this range now 1, 2, 3, 4, 5, 6. By the 7th day, we've been in this range for 7 days. My feeling is I don't want to be trading Marty unless we're getting a trend to the upside, or I want to be trading Marty once we broke down to the downside and we start to consolidate again. But I don't want anything to do with trying to run Marty when we have a bearish bias and we've been in a consolidation period for some time. So I know this was a lot of information, and I know I probably beat a dead horse multiple times, but that's how I'm breaking these things down. There is a much higher potential for reward using KPLs in this type of scenario than it is to just set Marty and forget Marty. And so hopefully you can use these things to, again, balance yin and yang everything together. And also, again, I guess the last little piece to that is, again, use KPLs in a scenario where we're going to be consolidating. You can use the KPL2 and KPL3, right? That's the key. That really is the key to really gaining some momentum and some monumental wins successively or consecutively in a row. So hopefully you liked this video. Let me know if you did. If you didn't, you let me know too. But I'm sure it will help those of you that really paid attention to all this stuff.